You ever buy and sell used tennis rackets?
Never.
Never.
No. I don't even know what I do with my old ones. I will say this: my goal for this weekend, because no family in town, is I'm eBaying my old paddles, my pickleball paddles I don't use. So I am trying to get rid. I've given a few away to people I know. This maybe speaks to the volume of paddles I have, but like now I'm at the point where it's like I need to sell some of these just to recoup my habit of spending on newer paddles.
Yeah.
I mean, I bought another paddle today.
Goodness, really?
Yeah. It's the same paddle I have. It's the same paddle I have. I like to have two of the same paddles
In case you break a string?
Yeah, well,
Give me
I've
a
never
break.
broken anyone,
Yeah.
surprisingly, but like you do clank, paddles with each other, and sometimes it's just I more like one does get old, and eventually you're gonna eventually just want to use the newer one.
Yeah. 2 rackets I get, 2 paddles. I don't know.
They lose. It's like they lose their grit, and so the surface becomes less gritty, which means that you can't put the spin on them. So they're cheap, man. These paddles, I bet you they cost $10-15 if that.
For sure. For
Yeah.
sure. Yeah. So I buy demo rackets, like used demo rackets,
Oh,
and have Daniel restring them the way I want. And I play with them. And I got one recently and I hate it. And so I was going to like eBay it, see if I could get, I bought it cheap. I'll sell it for what I bought it for. It's like not much. I figure I could sell it. But then when I was on eBay, I saw another racket and I was like, oh, maybe I'll sell this one, buy that one. And I can just cycle through a bunch of used rackets on eBay and just get them.
do you know how much it costs, just out of curiosity, to ship a racket?
I have no idea. $20, $15.
I mean, I feel like a used racket sometimes may only go for 75, 80, $90, and then you have to pay $20 for shipping.
Well, that's what this racket, I put a bid on it for $75 or $78, and then it was another, I think, $15 to ship, $20 to ship. But then the bidding pushed it up north of $120, which would have landed you like at let's call it 150.
Yeah.
And for 200, I could buy it new from
with probably free shipping, right?
Yeah, exactly. But I don't want to go down that road. I wanted to buy used. I bought it's a head precept. I got it for, I think, $75. I was going to turn around and I re-gripped it and put new strings in. So I'm out that money.
Okay, real quick story, not to go off on the path, but
yeah.
I had a friend. I actually play a lot of pickleball with him, but I knew him because he was on my. I actually went to high school with him, played on tennis team, and we played as adults. And he bought a racket off of eBay, and I don't know how we came to this, but we popped off the bottom of the cap, and when you saw it, you saw they use nails in there to put everything together.
Yeah.
The nails were also discombobulated. You can just tell it was a fake racket.
Oh, really?
Because it wasn't. Every other one's pretty uniform in terms of the stapling of it, and this one was like when you looked in the butt, you can tell it was just everywhere. And so it was the running joke that he had bought a fake racket that he's been using from eBay, but that's what it was.
Interesting.
Yeah.
Well, that gives me some pause. Well, at a minimum, I can sell the one I don't like that I'm probably never going to play with, that I bought for $75. I'll sell it for $80 and tack on a little shipping just to cover the grip and the strings I put on it.
It helps cover the expenses of your other.
Yeah, I figure it's a loss, but I can make it a $10 loss, not a $80 loss.
Yes.
Okay. Well, this might make it into the intro. I don't know. Maybe we'll hold open. Welcome back to the Casual Friday Financial Insights podcast. It's been a couple weeks. I think we teased this episode last time we did this, Ryan, right?
We did.
We're talking Midyear Outlook, and it's already up on the screen. I'll take it down here just for a second, though, because we have some other things to cover first. Despite talking about hawking pickleball paddles and tennis rackets on the secondary market, I usually like to start with a question. When you were a kid, what did you want to be when you grew up?
I didn't have anything super strong. There was definitely, I guess, a point in time for some reason I wanted to be an optometrist.
Of all things, why?
I don't know. Maybe it's because I liked my optometrist. Not like, he was a good guy, like he was a fun guy. And so like I think it maybe played into like, oh, he could, he comes in the office and he kind of talks a little bit, gets to socialize with people.
Yeah.
He's a doctor still. He's not doing surgeries. And so it seemed kind of appealing, like it seemed like laid back enough.
Sure.
And he actually just retired like 3 weeks ago or so. But yeah, it was.
That's what you want.
But it didn't stick around. I wasn't like I went to high school and was thinking, oh, I got to take bio classes and do this to get into. And it just kind of floated away after a while.
There you go.
Did you have one early on?
Yeah. I wrote an essay in 4th grade. I wanted to be a lawyer.
Oh, look at you, making dreams come true.
Making dreams come true. I think it's not so much diligence, but stubbornness, because I went to law school and did a lot of history and writing, and then was a poli-sci major in undergrad, worked in government for a little bit and parlayed that into admission to law school and practice law. Yeah. I think that's what made it so bizarre when at this point, 17 years ago, I quit practicing law to do this. And people thought I was nuts because they're like, you've arrived at this thing that you've wanted to be your entire life. Yeah. Not just adult life, but life. But this is still a better gig than being a lawyer. I'll tell you definitively.
I tell your story all the time, to be honest with you.
You tell what?
I tell your story all the time.
Oh, my story?
Yeah. Mostly your Thanksgiving story to people that talk about law. I'm like, oh, well, here's my story of my business partner that, how he came into this profession.
Yep. Don't get me wrong. There were parts of practicing law that I liked a lot even, but there were other parts that sucked. And, I talked to a lot of lawyers and half of them are trying to find their way out. I think the profession has changed over the last couple of decades. I'm not one of those guys who say, remember the good old days. It used to be better, but it did used to be a little bit different, along with a lot of professions, right?
Everything evolves, but
sure. Well, just imagine 20, 30 years ago, how you would take a trade order from a client and execute it, right? Just things changed and started moving faster. And I don't think that the practice of law, the way it was really built for speed that way. And it's just, I don't know, stuff. Okay. So we're talking mid-year outlook, but let's first do a little bit of market recap, because it's gotten a little spicy out there, Ryan.
Yeah. Things are changed, kind of actually a little bit changed from the first half to the first few weeks, even I'd say of the second half. There's some
there we go.
Key things going on.
So here's the last 5 days. If you're watching a lot, you'd think it was a total bloodbath. It's because it has been not great, but the Russell 2000 small caps up 1 3/4. The Dow registering positive for the week. S&P 500 down almost 2%. NASDAQ down almost 4%. I think the real change is if we go year to date and take a look here, you can see this tumble going on right here. It feels a lot like April, where we shot higher and then cratered here lower. The shot higher seems to be, especially with small caps, markets starting to pivot and recognize that rates are going to get cut probably pretty soon. And so there was this positive reaction in the Dow and in small caps here, and an almost immediate negative reaction in the things that were probably a little bit overvalued, tech stuff, right?
Yeah, I think you could call it like money was rolling out of one and into the other. Yep. In fact, I think that the performance of the small caps for like a 5-day period versus like his 50-day moving average was like 4 standard deviations above. Like it was like unheard of, the performance like it did in like a 1 week period.
Yes.
And you can see it really like, yes, it's gone down this week along with the NASDAQ, but that shot up, it was just straight. It was straight.
It was a hell of a pop. I don't know if it's going to stick. And I think that's really, we'll talk about this some more, but I think what we're seeing here, I don't know if this was, some people call it a rotation from growth to value, or from large to small, or a pivot, or whatever you want to call it. I think though, this is, we've talked ad nauseum about how oddly serene things have been in the first half of the year. And as we get more uncertainty, not even related to the election, but just what's going on with rates, what's going on with the economy, markets are going to have more days like this, or more weeks like these that are going to be a little bit twitchy, let's call it. So I don't know. Have you had people call nervous?
I have not yet. And what usually spurs people is like when they see the monthly statement.
Sure.
I will say the benefit, if we kind of where we are versus like the beginning of the month, we're basically kind of flat with the markets, which is good. So even though we've had a really kind of bad week,
right,
the month as a whole is actually pretty flat. So
yeah.
I don't know that would spur clients to call me if we weren't negative for the month.
Right. Well, this is month to date.
Right.
So as we wrap up the third week of July, which is crazy to say, through the 19th, Dow's positive, S&P's positive. It's just the NASDAQ and the tech stocks that have gotten beaten up. So, yeah. All right. Well, let's dust off the crystal ball and talk outlook.
All right.
So LPL Research, we're associated with LPL, released their Midyear Outlook not too long ago. We're not going to cover all of it. I think we're going to talk some highlights here and get into economy, stocks, bonds, maybe some geopolitics, although that's kind of, here's the reality, Ryan. We don't even know who's going to be running for president.
Right.
In a couple of months. And it could have been somebody different a week ago, if you know what I'm saying. It's like
it's a circus. It's a circus right now, and
circus.
That's happening.
Exactly.
It makes for good drama. It seems as if that's kind of what we're living.
Well,
we're living like a soap opera right now.
Yeah. Well, cable news has turned politics into infotainment, right? So instead of watching Entertainment Tonight, they're watching talking heads on cable news, and it's anyway. I'll get off my soapbox. All right, let's talk economy. So we're starting. We've got some charts to show, but I'll give you the rundown here, Ryan, and then we can talk charts a little bit. I think the bottom line that LPL Research had was that the first half of 2024 was surprisingly resilient in terms of economic growth, but it had some sticky yet decelerating inflation. So that's a good thing. I think if you had asked us this time last year if we thought we were going to have a recession this year, we probably would have said yes.
Right. And that's where you're talking about the resilience, is that the expectation for a while now was like, we should probably have a recession by now. And it just hasn't happened. And it's not necessarily going to happen, right? In the second half even. But yes, definitely better. More, the expectations were exceeded in the first half of the year versus what we did.
These slides are, if you ask why haven't we had a recession yet? Well, the wealth effect is one reason that the rate hikes didn't really impact consumer spending, because people were tapping their home equity, refinancing. It's like 50% of mortgages are below 4%. So interest rates are rising, but it didn't really hit anybody with their homes because they either bought or refinanced recently. And so you get pandemic stimulus programs, excess savings, good housing conditions, and people like revenge spending after COVID, and that can prop up the market a little bit.
Well, as you can see with this chart here, people, it says billions of tapped home equity. You can see on the far right of the chart, people during that COVID period of time were pulling home equity out of their houses. Yep. But again, as rates have gone up over the last couple of years, people don't do that anymore. So you had a pile of money that could have been used, but now you don't.
Right. Well, also, we have more. I'm going to click through here. We have more homeowners than renters in this country, and nearly half of them don't even have a mortgage. And even if you do have a mortgage and it's below 4%, you have more than half of the economy that's not interest rate sensitive in terms of their housing. That's another reason why people can stay resilient, I guess, as interest rates kind of click higher. I think though what LPL says, and I tend to agree with them, that you can't expect this resilience to last, because as we'll click through here to the next few slides. There's already a few signs of a slowdown in the second half of the year, and data shows that spending is slower at lower income levels, and the labor market starting to soften some. We've seen that where the unemployment, we've gone from 3.5 to 3.7 to 3.9 to 4 to 4.1. That's recognized. I know employment's a lagging indicator, but that suggests kind of a softening economy.
Well, I think, like, to add to what you just said, like anecdotally, we've all seen this, which is restaurants are really busy, travel's really busy, everything's really busy, with costs being astronomically high. I mean, the cost of going out with the family or travel and all this stuff is, ridiculously expensive, yet everyone's doing it. To expect that to keep going on in perpetuity doesn't seem logically right. Like, that everyone's able to do this, and it's like 25-40% more expensive than it was, several years ago. Just doesn't add up that, like, it can keep going forever.
Right.
And like anything, the economy could be cyclical, and it's too. So we're going to go through periods where things are going to soften. People are going to feel a little bit more pain. And I think LPL is really kind of predicting that that's going to happen in the second half with slower spending and a softening labor market as well, right? People don't have jobs. They're not getting the same rate. They're not getting the same raises, as they were the last couple of years. That all has an impact on the economy.
Well, and you can see here on some of the key variables, that's top category is real GDP quarter over quarter annualized. And, it shows going from 2.2 to 1.4 to 1 in the fourth quarter of this year. So it suggests slowing, but not shrinking, which would mean no recession. But hard landing, soft landing, you're still coming in for a landing, right?
Sure.
And we're not going to be quite as high flying as you look. Third quarter of last year, we were up nearly 5% quarter over quarter in real GDP. I think it's interesting. They're suggesting also the unemployment rate's going to click marginally higher.
Well, that's the trend you see, right? The GDP numbers generally, in the quarters, has been going lower, which slows economy, and the unemployment numbers are getting higher quarter over quarter. Yep. So, it is good reason to think that things are going to soften up in the second half of the year.
Well, and they also think the Fed's going to cut rates in the second half of the year. And even though they don't say it explicitly quite so in quite these terms, you can look here on the annual forecast, and it looks that you can see at the end of Q2 here, the upper bound Fed fund rate is 5.5. They're expecting that in the third quarter to go to 3.25, which would suggest a rate cut in September.
Mm-hmm.
Right.
And
then another rate cut in either November or December, getting us down to 5% upper bound in the fourth quarter of this year. So forecasting 2 rate cuts, I would say that's probably a fair estimate, wouldn't you?
Yeah. I think it points to the fact that a softening economy, they need to be accommodative and start changing the rates to help the economy as well.
Yeah. Do you think they're going to cut in September?
I think that's a slam dunk.
Is it? I like slam dunks.
I like slam dunks. I heard this guy make the case for a 50 basis cut, and it did make sense, but I just don't
50 basis points in September.
He thinks the reason behind it is the economic numbers show that we should be lowering interest rates already. Like, why would you wait months until September to help something that needs help right now, right? But if you're going to wait, then you're basically, he thinks that you should do it July, should be a quarter, and then September, but they're not going to do it in July.
Yeah,
they're not going to do it in July. So basically, he's adding those together to say that that's now the remedy that they're going to they should be doing. I don't think that they're going to, just because.
Who is this guy? Was it a guy begging for change outside of the grocery store, or was it some guy?
No. This was a economic podcast I was listening to. Well, no real stake in the game. It was just, his reason kind of made sense with things softening. That if things are kind of softened already, why wouldn't you react now? It makes some logical sense.
Yeah, I guess We'll know more in 2 weeks, right at the end of July, because Powell's either going to say no, we're not there yet, or they're not going to cut, but they're going to start talking real dovish, and that's when you're like, oh, okay, September's coming. He's priming the pump.
He's primed for September. I think that the markets have that pretty much priced in, and then now we're waiting for what's the language for any future cuts, and when is that going to be?
Yep. All right, let's talk stocks. Because speaking of Powell, November 1st, he says they're done raising rates and stocks start ripping. Stock market soared in the first half of the year, really driven by the anticipation of lower interest rates at some point this year, even though, remember in January, people were talking 7 rate cuts in January,
right.
And that obviously isn't happening. And so the rally, in LPL's opinion, the rally was impressive, but that also means a lot of the good news was pulled forward into the first half of the year and is already maybe factored into the markets. The slide that we're looking at is the fact that we're approaching the second anniversary for the bull market that we've been in since October of 2022. S&P 500 has gained 52.8% since then through this is through June 21st. So this isn't current through the middle of July. So it's done even better still, slightly. Right.
So one of the positive takeaways from this chart is that we're below the average. So there's room to grow still.
Yeah. The historical average gain for a 2-year-old bull market is 60%. So given the fact there's some more time in front of us, we're kind of like right on track with the average. I don't know. It's kind of this is
guess. There's a lot of guesswork when you're trying to guess where something's going to be at the end of the year. I looked at LPL's number in terms of where they expect the S&P to be at the end of the year, and it's about, when I calculated it, I think yesterday or the day before, it was about 13% lower than where we are. 12 to 13% lower. So they definitely are expecting a bit of a pullback from the slowing economy to play into the S&P 500.
Yeah, sure. Yeah. And there's some historical numbers that kind of work or help with your kind of context for predicting what's next. I don't know that this is one of them necessarily.
Yeah, I would not use this as an indicator to say that, we're because we are below the average that we're going to go up to.
We're going to make it to the average. No, the average is the average because a lot of things hit above and a lot of things hit below.
Yes.
I think this one's a little bit more helpful because this is talking about the Fed pause and how stocks perform during when the Federal Reserve pauses as they are right now. And that's defined as the time period between the last rate hike of a cycle and the first rate cut of the next cycle. And so the current Fed pause is at roughly 300 and something days, second longest pause in history, trailing only 2006 and 7. The S&P 500 has risen 5 of these 6 pauses with an average gain of 13%. I'm not going to stay on this chart too long because this pause is about to come to an end pretty quickly.
Yes.
Right.
We're living on borrowed time with maybe another little over a month left of this.
Yep. Yeah. And so what's going to cause stocks to grow? Earnings growth. And maybe even earnings surprises, right? Because if a lot of the future good news is pulled in, future gains are going to rely heavily on corporate earnings growth, continuing to surprise really because valuations are really, really high.
Well, and I'd say the one problem, this is the way out, right? This is how you get higher returns, but it is contradictory to everything we just said.
Totally.
Earnings growth implies that people are spending money, companies are making more money, and yet all we've been talking about really is the second half. There's reasons to think that things are going to slow down because consumers aren't spending as much. So
right.
If they're not going to spend as much, that's the signs that we're seeing, and unemployment's going higher, it's going to be hard for companies to have accelerated growth.
Yep. So what do you do instead of stocks? Maybe take another look at bonds, which we've also covered how terrible bonds have done in the last little bit. But stocks are expensive, but in the flip side, bonds are pretty cheap. especially comparing one to the other. So it could be an interesting time to kind of explore bonds and if you're a value investor, there might be some value there in bonds. I don't know. It's not time to cut and run just yet, but
we are a little bit on shaky ground, I think.
Yeah, it feels like we're playing musical chairs, and we all are moving slowly around the last few chairs, waiting for the needle to come off the record. And we can squeeze
one other thing that has been talked about, and AI has been such a big topic the first half of the year, even last year, right?
Yeah.
And really, you could make the argument that it's kind of carried the market. I think that is what is going to be important for the market to continue to prosper the stocks, because if companies are actually using the AI and it then becomes, they're spending a lot of money on it, right? So the argument is, if they're spending so much money on it, they need to eventually extract value out of it to make money, right?
Yeah.
And so if they can actually start to do that, that may keep this kind of AI trend keep going. But if they start to falter where they're spending too much money, but they're not getting, any revenue from it, or not enough revenue to justify it, that's where some concerns could come in with the market as well.
Yep. Let's move on to bonds, or continuing. I think we're transitioning to bonds anyway, just kind of naturally in this conversation. So, we've said that it's been a difficult few years for bonds. And frankly, the only reason they were up last year was because they spiked in the last 2 months of last year. If they hadn't done that, it would have been 3 years in a row negative for the aggregate bond index, which would be the first time in history, coming off of it being negative back to back for the first time in history.
Right.
But now could be a good time to replace some cash holdings with bonds to lock in some of these higher yields that we've got. And, rates on cash accounts and money markets and maturing CDs are going to drop once rates start to go down. And so that's why I think taking a good look at bonds is a good thing to do. I think it's interesting. Current market pricing suggests that the Fed is only going to take the Fed fund rate back to about 4% or so before stopping its rate cutting campaign.
I've heard some people say, in the threes. I don't really recall anyone going below, somewhere in the threes, low threes as being a place. And that could even take multiple years to get to. 4 doesn't sound that off to me.
Well, if your podcast guy is right and they cut 50 basis points in September, they only have 1 or 2 rate cuts left. And then that's a wrap on cutting rates. I don't know.
I think we will be dependent upon the economy about where this is going to all fall out, yes. Right? If things slow down and they continue to slow down, even though interest rates are cut, it's going to show that those interest rate cuts aren't enough, and so you got to do more. And so it could lead to something faster or more than anyone really expects.
Yep. Well, I think LPL is saying that they expect the 10-year Treasury yield to end the year in the 3.75 to 4.25 range, based upon an economy that has held up better than expected and inflationary pressures remaining higher than the Fed's 2% target. That'll likely result in a gradual reduction of interest rates over the next 2 years. But in the year, if the 10-year ends the year at 4%, that's not bad. We'll have to have Joe Perry call in the conversation and let us know what a mortgage rate looks like with a 10-year Treasury at around 4%. It's better than it is now. But even the average 30-year mortgage is below 7. I want to say it's like 6.5, 6.75, something.
Right. It feels too like maybe we're going to get back to like a more traditional time where bonds act like what we've experienced most of the years prior to 2022.
Yep.
Not very volatile. They provide some safety. They're giving you some income. Now, I know that I probably would have said that too on January 1st of this year.
Yeah.
Thinking that we were going to get back to normalcy. And then we actually spent the first 4 months with a more than normal volatile bond market.
Yep.
But with the interest rate cut seeming like a slam dunk in September, that's got to spur on the momentum for rates to start going down. Like they're not gonna. I just don't feel like they're gonna do it once and then be like, yeah, we're gonna let it sit here for 6 more months. It doesn't make any logical sense to cut once and let it sit.
Well, and if you're a bondholder and you've waited this long, you didn't come this far just to come this far, right? You've endured all this pain. I tell this to people also, when we're October of 2022, like you've endured the pain. Stick around for the good stuff that comes as a result. Don't bail out just when it's painful. That now you put in the work. Stick around for the reward. Same thing's going for the bonds here. If you've stuck around through this roller coaster ride in the bonds, don't give up now.
Yeah, you just might as well. You got to wait and sit through the Fed lowering interest rates, and that's all we've been waiting for all these years. You're getting very close to the goal line at this point.
And you don't necessarily need to turn your equities into bonds. You can we have Ryan, I've done more money market funds in the last 24 months than I have in my entire career combined. Combined. Hell, I've probably done more in the last 6 months, or in 6-month increments over the last 2 years than the prior 15 years combined. So the yields for current bonds and cash are similar, but bonds actually offer portfolio protection and potential price appreciation when something negative occurs that you don't get from cash. And over the last 40 years, bonds have averaged a 6.4% annual return, which is about 1.5% better than the 4% return of cash. Moreover, with everybody kind of parked in money market funds, those rates are going to adjust. The fund that we use went from 5.25% to 5.15. Now it's 4.99. 4.99 is still great to get on cash, but it's all about trajectory, right?
Yes, everyone needs to realize, and I get a lot of these questions, or I prompt it, in meetings with clients that do have money market funds. And I think a question I often get is they'll say, "Is this still paying over 5%?" I'm saying, "Yes, it's paying
for
over
now."
5%. But yes, but I said, come September, and an interest rate cut happens, you're going to see it go lower, and then the next interest rate cut, you're going to see it go lower. So you just need to be prepared to know. What are we going to do when these rates go down, and maybe they're not as appetizing to you as they once were?
Yeah. I think the bottom line is we're starting to hit that inflection point where it's really hard to truly understand what's next. I think we got the gist. Things are going to slow down, rates are going to come down, but in what way and what black swan thing is coming? We've got valuations. There was a chip making company that was the largest company in the world by market cap, trading at 44 times forward earnings. Like, damn. And so you've got to kind of be weary about what might be coming, and stick with a balanced portfolio instead of trying to time this. Oh, stocks are about to go down, bonds are about to go up. You could be in that pain trade for months if you don't have a little bit of all of the above. And that's how you remain conservative, is by being balanced. All right, we've done this once already, but we're in the middle of the year of an election year. Let's just touch on politics, because we have to. We've got a Republican National Convention going on. There was an assassination attempt on one candidate. There's talks about the other candidate starting to drop out because of capacity issues. We don't know. We don't even know who's going to be on the ballot in November. But I think the fact is here that markets are neither red nor are they blue. They are green. I don't want to say people don't care about who's in the White House, but it matters a whole lot less than you think. It matters to you as a citizen, but maybe not so much as an investor, right? But the geopolitical environment's uncertain, and it can be disruptive, right?
And I think just normal human tendency with something that is as big as the elections, people directly think that it's got to have some large impact on the stock market, right? Yeah. But I do also say this. I think when I have that conversation, I tell clients it's not. I think actually they are relieved to hear that historically there's not like this big volatility that comes around with the elections.
No. The day after the election, there's going to be a line at Starbucks. Costco's going to be busy that Saturday.
Yeah.
Apple's still going to be selling the heck out of their iPhones. People are going to still be wearing Nike sneakers. And you're invested in companies like that, not kind of this abstract yeah, I don't know. It's hard to get people because everything is politicized and seeps into everywhere. It's just not. History has shown this not necessarily here. This is a tired slide because it shows how really when you have divided Congress or different parties in controlling the White House and controlling Congress, stocks tend to perform better because you don't have that big sweeping change left and right. We've talked about this quite a bit. Mm-hmm. I think interesting, the other slide is the dangers of investing only when your team is holding the White House.
This chart's absolutely crazy.
Right?
the spread between this is like, why would you, you don't want to bet money on based upon your political affiliation and the stock market. Like,
no, because the economic cycle really drives everything. But
yes.
And they're more powerful macro forces catalyzing economic expansion and contraction, like the health of corporate America, consumers, monetary policy, right, with the Federal Reserve, so I'm going to read the notes on this chart. If an investor placed $100,000 in the S&P 500 back in 1950 and only kept their money in the market when their preferred political party was in the White House, they would have around $3 million if they only invested during Democratic presidency years, not including dividends, and $1 million if you only invested in Republican presidency years. Now, there are some differences in there. You know, you got the go-go Clinton years, but you have the 80s with Reagan and so on. But if you think a $2 million gap difference is pretty big, if you had invested that same amount, that same $100,000, and just let it ride from 1950 to now, you would be at 32.5 million. So it's a delta of 31.7 million. If you had just gone with your team, that's like, if this doesn't, I like this chart better than the other one.
Yeah, right? This definitely just screams let your money stay in the markets, take the political features out of it, right? And just invest your money.
Be a disgusting capitalist and invest in businesses and companies and markets that produce things and do things and adapt. More importantly, you get some restrictive policy coming out of Congress or the White House, that's one thing, or some loose policy coming out of White. Markets are like water. They're just going to flow to the lowest point and figure out how to make money on it. Or businesses are going to do that because they adapt to survive. I want to be part of that. You know, not the theatrics that are going on during the Democratic and Republican national conventions. Like those are television shows, everybody. Damn. Right.
You're just saying you want to be at the black line, not the blue or the red.
Yes. They should have made it green. Well, I guess there's a green party, so I guess they can't do that. What color? Purple? That's both, right? They should have made it purple. Oh, yeah. Don't let politics seep into this stuff. All right. So we've gone the Midyear Outlook. I'll recap just really quickly. What did we start with? We started with the economy, and then economy, stocks. Economy, first half was great. Economic slowdown in the second half, so prepare yourself. Stocks soaring in the first half, probably pulling forward a lot of that good news that we expected this year, rate cuts and so on. Unless we get some real corporate earnings surprises, stocks will probably not have the same second half that they had the first half. Doesn't mean they go down, but they may not go up quite as much. Bonds, we're starting to reach that pivot point where bonds have had a hell of a time because rates have been rising. And as rates start to fall, could be a good time for that part of your portfolio that you should have held on to anyway. And if you're sitting in cash, might be a good opportunity to start getting better returns as interest rates are falling on your cash to lock them in with better interest rates on bonds. And to top it all off, ignore the politics.
Yeah.
That's a pretty quick recap. Okay. Ryan, what's on your mind this week?
So as you know, I've mentioned to you, so my family right now is in Phoenix and they've been there since last Sunday. It's interesting, like when your family leaves, how much, like how you feel, like how you decide to fill in your time. And during the work week, it's pretty easy. Like I go to work, right? So it's the bulk of my day. Honestly, I'm going play pickleball at night, which is fine. But the weekends become absolutely boring. I will tell you, because I can only fill in so much time playing pickleball, which is about 2 hours. Then I have the rest of the day, and I'm like kind of twiddling my thumbs around, and I realize, man, it is kind of boring without my family around. And so it's quite the experience in terms of, learning this. Sometimes I think you think, oh man, I have all this time, I can do all this stuff, and it's like it's not as much fun as it's all cracked up to be. I will say this, like a little later today, I am going to go filling in my time again because I got nothing else to do tonight. I'm going to go to a cryotherapy session. I'm going to kind of go check it out.
Have you done this before?
I've never done it before, so I'm kind of excited. My knees are bothering me from playing all this pickleball.
Dude, I want a full report on your cryotherapy. Where are you doing this?
I chose a random place. There's quite a few places in Fresno that do it. Okay. This was kind of spur of the moment, so I kind of Googled some places who was basically open that today that could take me. And so I'm going. I think I would say maybe they're down on Palm, but there are quite a few places here in Fresno.
Okay, I want a full report back. My knowledge of cryotherapy begins and ends with Antonio Brown.
Oh, geez, don't
when he froze his feet off before reporting to training camp for the Raiders.
Oh, thanks. Well, I'll make sure that they put their
good
booties on me, and I wear.
Don't jump in the swimming pool before you go into the cryotherapy chamber, right?
Yeah. Okay.
That's interesting. Well, I totally agree with you. When your family's out of town, it's like I went up. You used to have a place up in the mountains, and I went up there one night. I was going to go up there for a weekend. Get away. My wife was like, "Yeah, go, decompress." I was like, "Cool." I got up there, man. I watched some baseball, fell asleep on the couch, and it was boring. It was boring. And when we travel for work, as we sometimes do, it's cool. And you get on the plane, and then you land. Flying's no good, but you land and you check into the hotel, and you go down and you get some dinner in the hotel, and oh, that's great, peace and quiet. And you get back up to your room, and you're like,
there's nothing to do.
Nothing to do.
Yeah, there's nothing to do.
I can't binge. I don't do the binge watching on Netflix. So
yeah, it's the same thing with me. I was on Sunday. I was trying to and I literally don't watch Netflix, but with the family gone, I was like, I got to kill some time. And I was watching 5 minutes on, and then I'd stop and I go do something else because I got bored. And it's like watch another 5 minutes, and I'll
watch an episode of something on Netflix, but I will not watch 3 episodes of something. No, I got stuff to do.
Yeah. What's on your mind?
Well, getting ready for a trip to Washington, D.C., which is going to be exciting. We're going to tour the White House. I think we might get one more. We might try and get one more episode in before I take off. But touring the White House, touring the Capitol, Air and Space Museum, doing all that kind of cool stuff. But I've been trying to catch up on my reading. My goal is 12 books this year, one every month. I was behind. I'm starting to get caught up. I think hopefully this trip we're taking a red eye, and I'll be doing a lot of reading on that. So I'll be getting caught up. But what I've watched lately, 2 things. After getting done saying that I don't watch Netflix, I've been watching Receiver on Netflix.
Oh, yes.
And have you watched that at all?
No, I've heard of it. And I've seen some clips on social media of some of the responses from the receivers that are in it. Yeah, it's very heavy 49ers, so I'm in. Very heavy Devontae Adams, former Bulldog, go Fresno State, I'm in. Yeah, and it's interesting. I like it. It's interesting. And the other thing I've been watching is the Hard Knocks, New York Giants Hard Knocks right now.
I think that's kind of fun to watch back office stuff going on. So I think my brain.
You're itching for football in July.
Yeah. Because we're a month till preseason starts. Although last night I didn't watch either. I watched a documentary, which I recommend. You can find it a couple of places, but it's on YouTube. From the channel is called King of Docs, so it's documentaries. It's the documentary is called Gradually Then Suddenly. And it's about the bankruptcy of Detroit.
Yeah, that's cool.
And it's like Detroit is toast. They are, barreling towards bankruptcy. And so they're cutting their obligations. Who loses? The pensioners who worked for Detroit, who rely on their pensions. You're going to throw a bunch of people into poverty. Are they going to sell all of their art because Detroit has a fabulous Detroit Institute of Art, which is a museum with all sorts of wonderful art that's valued at like $8 billion that could help save them. But they didn't want to do that. The banks are saying, do it all because we want our money back. It's a really interesting.
That's an interesting peek behind all the decisions that have to be made.
And all the players are interviewed. The emergency, I forget what his name, emergency referee on this thing that was appointed by the governor, and it's largely driven by race, right? Because the capital, you have this white governor in the capital of Michigan that's not Detroit, and then you have Detroit, which is black, urban, different from the kind of countryside Republican white. It's fraught, it's layered, and really interesting. It's an hour and a half. If you're on the treadmill and you pull it up, I think time will fly. I think it's interesting, and it's not that far away. Like, this happened recently, and it's been interesting. In the Wall Street Journal, there's been a lot of articles on how Detroit is flourishing now. And it's thanks to these really hard decisions that had to get made. I think it was 9 years ago by the city to find rock bottom so they could crawl their way out. Because if they didn't hit rock bottom, Detroit wouldn't exist maybe at this point, Barrett.
I mean, is this like a little bit telling of the situation on a smaller scale of what's happening in the US, right? Like, hard decisions eventually may have to be made. And, eventually, if you make the hard decisions and they're the right decisions, you can have a turnaround.
Yeah.
Right?
It requires
a positive outcome.
Yeah.
But
it requires
it's going to require governance decisions.
Yeah, it requires guts and governance.
Yes.
I've watched a documentary and read some Wall Street Journal. I'm no expert on what's going on in Detroit. And I'm sure there are still some people there that are fired up about getting the short end of the stick of what they were promised.
For sure.
But it's a really interesting take on the largest bankruptcy in our country's history. Was it bigger than Lehman? Certainly the largest municipal bankruptcy. I can tell you that much.
Yeah.
Yeah, it's interesting. And then you layer in race and urban and rural and political party differences, and all of that needed to be
storylines to this.
What's that?
There's more storylines to this because of that.
Yeah. And good things are happening in Detroit now, which is cool, which is great. Just in time for Fresno State to go beat Michigan here in like a month. Right?
Yeah.
Anyway, I didn't mean to
lose our coach. Yes.
Yeah, I didn't mean to get going on, but the documentary is called "Gradually, Then Suddenly," which is a quote from a Hemingway book, and things were getting bad, and then they suddenly got worse. Just like, what's going to happen with unemployment, where it goes up gradually, then suddenly. All right, we'll leave it there. We've been rolling for quite a while. I don't think I told anybody to subscribe at the beginning. Please subscribe if you're still listening. If you're still listening, you're subscribed. I'm sure of it. Maybe give us a like, give us some stars. Isn't that how it works on podcasts? You can say that
we need the algorithm to work our way.
Yeah. Well, we'll see. All right. We'll try and get one more of these in July, maybe next week. And until then, Ryan, good luck with your freezing yourself while your family's away.
Yeah, hopefully it'll feel good, and I'll report back how it comes out.
Excellent. All right, till next time.
All right, bye.